In 2005, a financial analyst named Harry Markopolos walked into the Boston office of the Securities and Exchange Commission. He carried a 21-page document. It contained mathematical proof, step by step, number by number, that one of the most respected investment managers on Wall Street was running a complete fraud. The SEC reviewed it. They assigned it to a junior examiner with no derivatives experience. Then they closed the case. 3 years later, $64.8 billion in claim investor assets was gone. Bernie Madoff confessed to his sons on December 10, 2008. He was arrested the next morning. The SEC had been handed the proof 9 years earlier. This is not the story of Bernie Madoff. You already know that story. This is the story of how a government agency, built specifically to prevent this, had the ants in their hands and did nothing with it. Bernard Lawrence Madoff built his reputation across 5 decades. He was not a flashy outsider. He was not selling courses online. He was not promising Lamborghinis. He was the former chairman of the NASDAQ stock exchange. He founded Bernard L. Madoff Investment Securities in 1960. By the 1980s, the firm was one of the largest market makers on Wall Street, processing roughly 15% of all New York Stock Exchange order flow at its peak. This is the part that matters for what comes later. Madoff ran 2 separate businesses inside the same company. The first was legitimate, a market-making and trading operation that was genuinely successful. The second was the investment advisory division. The advisory division is where the fraud lived. Madoff managed money for wealthy individuals, hedge funds, feeder funds, and charitable foundations. His reported returns were extraordinary, consistently around 10 to 12% per year, regardless of what the broader market was doing. In a year, the S&P 500 lost 20%. Madoff's clients made 10%. In a year of market volatility, Madoff's returns were smooth, predictable, impossible. His strategy was called the split strike conversion, options combined with blue-chip stocks. In theory, a reasonable approach. In practice, it could not mathematically produce the results he was reporting. Harry Markopolos figured this out in 4 hours. Here's how the fraud actually worked. Bernard L. Madoff Investment Securities maintained a specific account, account 703. This was not a trading account. Nothing in account 703 was ever actually traded. No options were purchased. No stock positions were taken. The statements sent to investors every month were fabricated. Every trade confirmation, every monthly statement, every annual return figure, manufactured. Madoff employed a small team, separate from his legitimate trading operation, whose only job was to produce fake paperwork. They used historical market data to backfill trades that never happened, choosing price points that would generate the returns Madoff had already decided to report. Frank D. Pasquale was Madoff's chief financial officer for the fraud operation. He later testified under oath that account 703 was, in his words, simply a big lie. The money itself was real. Investors wired real dollars into real accounts. But instead of being invested, those dollars sat in a JP Morgan Chase account. When investors wanted withdrawals, Madoff paid them from new investor deposits. At the moment of collapse, Madoff had $234 million in actual cash against $64.8 billion in claimed investor balances. That gap, $64.5 billion, is the largest Ponzi scheme in recorded history. His investor base was extraordinary. The Fairfield Greenwich Group had $7.5 billion with Madoff. The Pickar Foundation, $7.2 billion. Tremont Group Holdings, $3.3 billion. Carl Shapiro, $545 million. Elie Wiesel's Foundation for Humanity, nearly $37 million, wiped out entirely. These were not unsophisticated retail investors making reckless bets. These were hedge fund managers, audited feeder funds, and professional allocators whose entire job was due diligence. None of them ever asked to verify a single trade directly, and neither did the SEC. There were 5 distinct moments when this fraud should have been stopped. 5. Not 1. 5. Red Flag 1. 1992. The SEC investigated a firm called Avellino and Bienz, two accountants who had been funneling investor money to Madoff for years, promising guaranteed returns. The SEC shut down Avellino and Bienz. They fined them. They forced them to return investor funds. But they never asked where the money had actually been going. They never looked at Madoff's operation. They were standing at the front door of the largest fraud in history, and they turned around and walked away. Red Flag 2. The options impossibility. Markopolos calculated that to execute the split strike conversion strategy Madoff claimed to be running at the scale he claimed to be running it, Madoff would need to control more options contracts than actually existed on the entire Chicago Board Options Exchange. The strategy was mathematically impossible at the reported scale. This was not an opinion. It was arithmetic. Red Flag 3. The batting average. Between 1993 and 2002, Madoff reported only 7 losing months out of 87, a win rate of 96.6%. Markopolos put it this way: even the best baseball player in history bats .400. Madoff was batting .966. In financial markets, across all market conditions, for a decade, no legitimate investment strategy produces that result. Red Flag 4. The 21-page memo. In November 2005, Markopolos submitted his most detailed analysis to the SEC's Boston office. The document was titled, "The World's Largest Hedge Fund is a Fraud." It listed 29 specific red flags. It explained the mechanics. It gave them a roadmap. The SEC assigned it to an examination team that did not understand derivatives. They interviewed Madoff. He was smooth, credible, and prepared. They did not subpoena his trading records. They did not contact the DTCC, the central repository that would have shown instantly that his reported trades never happened. They closed the investigation in 2007. Red Flag 5. The 2 sets of records. Madoff's legitimate trading operation used a system called Beta. His fraudulent advisory division used a separate, standalone system called AS400, physically isolated, accessible to only a handful of employees, never networked to the rest of the firm. The SEC examined Madoff multiple times. They never asked to see the AS400 system. By late 2008, the global financial crisis was accelerating. Markets were collapsing. Investors everywhere needed liquidity. Redemption requests began arriving at Madoff's office at a rate the scheme could not absorb. In the first week of December 2008, clients requested approximately $7 billion in withdrawals. Madoff had $234 million. On December 9th, 2008, a Tuesday evening, Bernie Madoff called his sons, Mark and Andrew, into his apartment on the Upper East Side of Manhattan. He told them the investment advisory business was a fraud. He told them it had always been a fraud. He told them he was finished, that he planned to turn himself in, that there was approximately $200 to $300 million left, and he wanted to distribute it to employees before the end. Mark and Andrew Madoff did not protect their father. The next morning, December 10th, 2008, they contacted their attorney. Their attorney contacted federal prosecutors. Federal prosecutors contacted the FBI. On December 11th, 2008, 2 FBI agents arrived at Bernie Madoff's penthouse apartment. Agent Theodore Cassioppi asked him, "Is there an innocent explanation?" Madoff said, "No, there is no innocent explanation." He was 70 years old. He had been running the fraud since at least 1981. Possibly since the 1960s. His own sons had turned him in. On March 12, 2009, Bernie Madoff pleaded guilty to 11 federal felony counts: fraud, money laundering, perjury, theft from an employee benefit plan, false statements, making false filings with the SEC. He did not go to trial. He entered the plea directly. On June 29th, 2009, Judge Denny Chin sentenced him to 150 years in federal prison. Judge Chin called the fraud, and I am summarizing his words, not quoting them, extraordinarily evil without any mitigating factors. The government sought $170 billion in restitution, representing the total amount of money that had ever flowed into the scheme. As of December 2024, the Madoffvictimfund has recovered and distributed approximately $4.3 billion to victims, representing a recovery rate of 93.71 cents on every dollar of eligible claims. That recovery rate is extraordinary for fraud of the scale. It is almost entirely the result of aggressive clawback litigation against early investors who withdrew more than they deposited. Bernie Madoff died in federal prison on April 14, 2021. He was 82. The question this case demands is not, how did Bernie Madoff fool so many people for so long? The question is, how did the system designed to catch exactly this fail to catch across 16 years and 6 separate complaints? The SEC's own Inspector General investigated. The report, OIG 509, was released in August 2009. It identified 6 complaints submitted to the SEC about Madoff between 1992 and 2008, 6 separate opportunities. The report found that examination teams lacked experience in equity trading and derivatives, that senior staff were not properly supervising investigations, that the SEC never once directly verified Madoff's trading through the DTCC, a step that would have taken hours and would have ended the fraud immediately. Let that sit for a moment. The central trade verification system existed. It was accessible. It was routine. In 16 years and 6 investigations, no one used it. Harrymarkopolos testified before Congress in February 2009. He told lawmakers that the SEC was a captured regulator, more concerned with the appearance of oversight than its execution. He was not wrong. After the Madoff case, the SEC created the Office of the Whistleblower. They implemented mandatory training for derivatives examination. They strengthened their tips and complaints system, reforms that should have existed in 1992, implemented in 2010. The fraud was Madoff's. The 9 years it continued after the proof was handed over, those belonged to the system. And the next question is simple. Who benefits when the watchdog doesn't bite? If you want the next file, subscribe. We publish evidence, not opinions.